The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
If you're building or buying or selling a home, the Real Estate Crew's got news for you at the Real Estate House Party.
With attorney Rick Carter,
Real Estate House Party.
paralegal Kathy Holtshouser,
Real Estate House Party. Come in, have fun.
and comedian Tony V. Now, here's real estate attorney Rick Carter.
Welcome and thanks for joining us here on the Real Estate House Party. We're joined again by the Iceman and Tony V, who told us last week, and I thought you did an exceptional show, but you said in the beginning of the last show where you might just take a little nap during the show.
I'm exhausted.
Just call us. Call me when you need me.
This couple of weeks has been brutal. It's been awful.
Yeah, I mean, last night I
need
dreamt
my
I was a
rest.
muffler and I woke up exhausted.
You've been waiting for years to tell that one.
Finally!
Well, that's all we have time for.
Thank you.
Thanks for tuning in.
Remember his crab story?
Oh,
It was like a 20-minute
Yeah,
story.
that was
The
20.
show was only 25
I got it right here.
Yeah, crabs crawling on
It was
other
crawling out of a
crabs.
bucket, and
That was the funniest thing. It was the first time I actually read it out loud, and I was halfway through thinking to myself, when is this going to end? And I know you guys were thinking the same thing.
There's got to be a point to it,
You
right?
ever do that in life where you say, "Oh, maybe I shouldn't have gone down this
Yes,
road"?
Yeah.
a lot of
Yeah.
times.
Yeah.
I've been down a lot of roads.
Oh,
that
yeah.
I should have taken a left. And,
Yeah.
instead of exactly.
Yep.
So we figured we had to get you back because we just kind of just poked the bear on a few things.
Yeah,
we
a
still
lot of information.
I have a lot of people call me since the last show. Like, just maybe we have to elaborate things a little bit more, and then we're going to get into some niche products.
Sure.
That you might offer. Again, we're not promoting just your company, but if you want to get a hold of John Marroni, do we even know John Marroni on Google you?
Yeah, just Google me, John Marroni, John, space, Marroni.
Oh, it's the
I will-
space you got to keep it.
Yeah.
That's the part.
Yeah,
If
yeah.
you put them together, you get.
Ooh, you're in big trouble then.
You get
Then
another.
you get the other John
You get
Marroni.
another John Marroni,
Oh, yeah, who
and
has
you don't
no
want
sense of humor.
You don't want to deal
No,
with him.
no, he's
I was
actually-
talking to someone from Chicago, and I asked her to Google me, and I came up from Chicago just by
Really?
my name.
Really?
Yeah. Google.
That's how she tracked you down?
Yeah, apparently Google thinks I'm relevant now. So
Because you have over like 100 reviews, right?
yeah, I just checked 127.
Wow.
I periodically get calls for a Tony V who owns a body shop in Minneapolis.
Okay.
Or something. So
And you take the calls.
I take the call.
Do the work, too?
I go, yeah, just drop it off.
We'll take it apart.
I'll have it by
Yeah,
Wednesday.
Yeah. Well, where is it? That doesn't matter. Just drop it. We'll take
I
care
used
of
to start, you remember when I used to start my seminars, but it was true, because I'd give them my cell phone number.
Yes, yep.
I'd give the number. I said, but don't use 942 with the same number, because in town we have 944 or 942.
942, right.
942 is a fertility clinic.
Oh, there you go.
So I got all those phone calls.
Sure.
So that was enlightening for a lot of
Sure.
those calls there.
Yeah. Deposits are different there.
Yeah, but
That's
I
a
think.
different sort of
Deposits
deposit.
and discharges
Charges
and
all kinds of things.
Well, you got so many calls. You should be certified. By
I know. Well, I am.
Certifiable.
That's what a few people said. I was certified when I did that.
Yeah,
So,
again, just leave your specimen in the mail slot. I don't care how it gets there. Yeah.
just
Should I
label
put
it.
my name on it? No,
No.
don't worry.
We'll figure
we
it
know
out.
where you live.
We'll do your DNA analysis. You'll be fine.
So, thank you.
This is a strange. This is a strange real estate attorney. He has a mop.
And some sort of, he's got a lot of apparatus around him. He says he uses them for his procedures, but
Something about a black light. too.
Kathy Holtshouser wouldn't be putting up with this foolishness.
No,
this whole
here's your
time.
chance.
We might not talk any real estate here now.
The
so.
lane is wide open.
I'm finding out, though, you guys are kind of meshing your personality. You and Kathy Holtshouser, kind of meshing your personality. You're like a real estate expert now.
I know things.
You know things.
It's just listen, we've been doing this for about 100 years. Something seeps in. You know what I mean?
Yeah,
It does.
Yeah.
It stays.
Yeah, right.
And Kathy's.
Yeah, it's like I don't know French, but I can order a croissant.
Yeah.
You know what I mean?
Yeah.
It's like you just pick up this stuff. I don't know.
And Kathy, she seems to be completely off the rails now. She used to try to keep us.
On. Yeah.
Now
She realizes how futile it is.
she gave up a while ago.
Yeah.
So Thank you for coming back. You got some niche products to talk about.
I do.
We have there's a lot of, up to about 4 or 5 years ago, everyone just, I'd get my fixed rate at such and such percentage point, and that was it.
Yeah, I know.
Right? Now, there's a lot more competitiveness out there with the lending world.
What do we consider a niche or a niche product? What?
Hey, give us one niche product to start us off with.
All right. Well, from the last show, we were talking about the cash program.
Yeah.
People wanted to clarify a little, just two seconds, clarify that a little bit. So you're almost coming in. Now, explain the part again where the bank is actually buying the
Sure.
house.
All right. In order to do that, we fully underwrite the borrower first.
Yeah.
Okay. Now that we know we have a solid borrower, they just got to put 5% down. The offer, the bank will actually buy the house. So the realtor, we have a transaction coordinator that gets with the realtor to help them write up the offer, and they'll also send over the proof of funds. So it's a bona fide cash offer. So when
the bank is actually the buyer.
correct.
Yep.
And when when that transaction happens, the realtor gets paid on that transaction.
Yep.
From the bank,
No, from the seller.
from the seller.
Yep.
So they want to keep everything the same. They don't want the brokers losing out on the deal, right?
Correct. Yep.
Okay.
And then at that moment, the bank owns the property, and the buyer, they don't own the property yet, but they can move in and they'll sign a lease.
So they must have all these agreements lined up beforehand.
Right.
Because then you don't want the buyer
So they're
saying,
leasing the house from the bank.
Yep.
Are
Correct.
they paying the bank for the time they're in there?
They are. But if they're also selling their house, the bank will say, all right, you don't have to pay us
Until you sell the house.
correct, because we don't want you, being strapped paying
Right, right.
two
Yeah,
mortgages.
Yep.
And then when they sell the property to the buyer, there's a fee of 2%. So how that works is, let's say they bought the bank bought the house for
Because people were
$500,000.
asking me, what the fee
Yeah,
would be.
what's the
Yep.
catch? It's too good
What's
to be
the
true.
catch? Right.
All right. So,
Right. Somebody's making money.
Someone's
Yes.
making the money.
So and there are other companies that will charge 5%. The reason why they try to minimize it at 2% because you got pretty much a half is transfer taxes, so they got to cover that, and then the other point and a half to kind of keep the program going. But what happens is the buyer doesn't have to come up with the 2%. What they'll do is they'll add it to the purchase price, the new purchase
they're
price.
making this pretty convenient.
Yeah.
Yeah.
So now they're financing, instead of a purchase price of $500, it'll be a purchase price of $510. So some people might say, all right, that sounds cool, but geez, why should I have to pay another 2%? Well, what they found is, after doing like 1,000 of these, all the surveys show that if someone is a cash buyer versus someone mortgage financing, ends up paying 12% less as a cash buyer.
Oh.
So,
Interesting.
so in reality, according to those numbers, someone would have probably with a mortgage finance and probably would have had to pay $530,000 for the house, or $540,000, but instead
someone who has this backing says, I'll give you $480,000. We're going to close in a week.
yes, and more important, let's say it's all even, right? Let's say those numbers are not correct. You get the house accepted, right?
Yeah.
And I know if I'm a buyer's agent, I don't want to show them the 101st house or the 102nd house that I've been showing them. I go,
Tony, would you be comfortable dealing with your lender saying, even if those numbers aren't correct?
Yeah. Yeah, it's fine. Well, if it was John Marroni, of course,
I'd buy that, though.
I'd buy
you know what I mean?
anything from
yeah,
him. Sure.
I'm not worried about that at all.
well, here's the thing.
Don't
Because
worry about those numbers.
Numbers, it's just numbers.
all right, let's say you're uncomfortable with that. Those numbers, okay?
Those numbers are not to your liking.
Yeah, okay.
We'll give you other numbers. No, we're not.
But we gotta,
we're not
numbers,
uncomfortable.
Numbers are infinite. We got all kinds of numbers.
Right.
We just put them in
Right,
there
yeah,
until they work.
Just rearrange them where you want them.
If I put that one in front of the other 10, it's a whole different number.
What number would you be comfortable with? What would it take you to drive this house out of this lot?
I can see you in this house.
We'll have the house washed by noon.
You wait here. I just have to go talk to my manager.
I'll be right back. All right, we derailed you, but I just thought that was funny. Go ahead.
So you do have another option. So we fully underwrite you. You're fully underwritten. You don't have to do this cash program. You can
I know.
you can make a regular offer, but knowing that now, instead of you're pre-approved, you're underwritten.
Yeah.
So your only condition is to get an accepted offer. So that makes you a stronger buyer as well.
So do you already have it appraised at that point?
No.
Okay.
No.
just
No,
wondering.
but
We're still making up numbers.
Yeah.
We're just making up
and
numbers.
conditions.
Right. We're just making up numbers.
it's under the
We're
Fibonacci.
spitballing right now.
It's
We're
under the
spitballing.
it's under the Fibonacci model.
No, we don't want to derail this spitballing going on. We're just curious. Yep,
You know?
yep.
What is it? So, what is it? Actually and hypothetically?
Oh, yeah.
Realistically.
Oh, that's it.
Hypothetically.
And hypothetically.
Yeah, well,
We're
that's
sitting
for
on
the
a
next
couple
show.
million. Yeah.
All right. So we derailed you again. Sorry
So
about that.
I really what this is a nice strategy to get your offer accepted.
Yep.
Period.
Yeah,
Because
right.
and it's a nice way of competing against the cash buyer because now you become a cash buyer.
Right.
Period.
How about this? If you don't want to go through all this where they're actually buying the house, you do have the program, which I like this one too, where, and I think we touched on it a little bit last week, where you're not using both costs involved with the present house and the house you're buying.
Right.
So
on this program, that's the case.
But can you also do that where I'm selling this? It'll probably be about a month.
Yep.
Is there a way that you're
Yes.
not?
Yes.
Yeah.
Yeah, we have that program too.
Okay.
Absolutely.
That seems like more
we call that
people
we call that the buy now, sell later program.
I know. So.
That's fair enough. That's fair enough.
And just so you know, the cash program, you don't have to have a house to sell. You could be a first-time home buyer to participate.
Oh.
Don't you need a house?
Don't even need.
No, you could just buy a house.
Buy a house. You got to start somewhere.
Yeah. Start out as a home buyer.
Can you do a few?
What?
Hey, can you do a few?
No, it has to be owner occupied.
All right. Now all of a sudden he's serious. Is
Yeah.
what the rules there.
Yeah,
all right.
You can't-
You gotta-
there's
draw the lights
There
on
are rules.
You know,
The rules seem to be flexible, but there are rules.
I am required to state them, whether you follow them or not. We'll see what we can do.
All right, so that's a good point. So one house, one owner-occupied house.
Yeah, it's
right?
owner-occupied,
Yeah,
yeah.
that makes
Yeah.
sense. So, all right, so you have those couple programs.
And it's limited to single family and condos only.
Yeah, that's fair enough.
Yeah.
That's fair enough. So no multifamily, no investment.
Not at this time. No.
Yeah.
Nope.
How about for vacation homes? Nope.
Nope.
No.
Okay.
No.
They don't like vacation homes these days. What's up with that, John? Marroni?
Because I think they're figuring if things go wrong, the vacation homes will go first. Like people will stop paying on it.
God, no, I'd keep that one.
Oh, of course.
Jeez.
I'd have to have.
Take my regular
Sure,
house.
I'd have to have somewhere to live after my wife throws me out for doing all this skullduggery.
Yeah.
I don't know.
Get
John
it?
Marroni said it was fine. I don't know what to
No,
tell you.
John Marroni said you need an exit strategy.
That was in his fine print.
Yeah.
All right, tell me, what is an asset depletion program?
So that one there is a nice way to help people get qualified. So post-closing assets. So if someone, after they close, have, say, $500,000 in the bank.
Okay.
We, in terms of calculating income, we'll take the $500,000 divided by 240 months,
Oh, boy.
or 240. That's it. That's where I
Writing
stopped.
this down.
So basically, the monthly payment would come out to about $2,100 a month that we could
Okay.
add towards qualifying income. Where I see that come in a lot is, let's say, first-time home buyer needs a cosigner, and I'll say to them, maybe let's get your parents to cosign. Oh, they make no money. They're retired. Oh, they got a Social Security.
But
I had someone that I had the parents cosign, and they had a lot of money, and enough. When I was, after calculating with this asset depletion formula, I was using $9,000 a month for qualifying income just
boy.
for the parents.
oh boy, did we get them a nice house then, huh?
Yeah, well, the kids finally, that's when they learned the parents had all kinds of money.
All of a sudden they going uptown to buy that house, huh?
I don't think I'll buy this house now. Yeah, right, exactly.
All right. What bank statement program? Do you just give him a bank? Oh, it sounds like he
Yeah,
likes that
he
one.
likes that one, yeah.
Now we're talking.
So let's say someone doesn't, whatever they make, they don't share with the IRS. Okay,
Yeah.
it doesn't reflect on the tax returns.
yeah.
So they'll take a look at the actual, say, 12 months bank statements, look at the deposits, and just
Which the IRS could be doing too, but go ahead.
Oh, they will be.
Yeah.
There's no question. And if the person also has, their own business, they could take a look at the deposits and go as high as like 90% of deposits. So if the average deposit's like 10 grand a month,
Yeah.
they might be able to use 9 grand a month.
Okay.
But I would say as a safe number on average, I've been seeing they just use like half of that. So
Okay.
10 grand a month
It's
deposit.
5.
Yeah, we're
Yeah.
using 5. Yes.
Thank you. That's about all I can do. That's about the extent of my math.
Wow, you know everything.
Prowess.
You understand
I
everything.
cut
Just
10
talking
right
about
in
that.
half.
You're learning a lot about this
Yeah,
real estate.
sure,
Huh?
sure.
You're just like a sponge.
Sure.
Aren't you? Yeah,
Yeah,
you're
he
just a sponge.
just takes it all in.
Yeah, yeah.
So there's a lot of different I mean, it seems like anybody can buy a house.
It's getting there. Here's the next, which leads me into the next
But doesn't
one.
that get us into trouble a little bit?
That's how it starts, yeah.
Yeah.
All right. All right.
Yeah.
Oh, so we're starting it right now.
Yeah.
Huh?
Yeah,
All right.
all right.
All right.
I'm
It's gonna be
telling you,
our fault.
Wall Street forgets, and there's a new crowd,
Yeah.
Yep.
and that's it.
All right, go ahead. Brings you to another one, you said?
Yeah, the debt service credit ratio program. If someone's buying an investment property,
Yeah.
they will just base it on the property's own merit. So, in other words, if it's
Which is fair.
yeah, so if they're getting rents of $5,000 a month and the total expenses are $5,000 a month, they'll do it.
They'll do it. That's
long
a
as
lot.
they
Yeah,
never-
20% down.
As long as they never lose that tenant,
Well, what happens after closing?
That doesn't matter.
you just want to get them there.
Yeah.
Okay.
Yep.
All right. All
That's
right.
that. Yep. And then let's see here.
How about reverse mortgages?
Oh, this is a good one.
This is a good one.
Yeah. So, nutshell, reverse mortgage is you get a mortgage and you don't have to pay.
You don't have to pay.
You don't have to pay. Just the interest accrues
Yeah.
every month. Where it works, you have options of taking out how you want to take out the money. Sometimes it could be like a lump sum, maybe a couple $100,000. But let's say you just want to set it in place so you can get a line of credit. And the beauty about, let's say it's a $200,000 line of credit, and let's say you don't even use it. The available line will increase by 8%. So after the first year, you're up to $216,000. A lot of people use that for a strategy. Let's say they have their money in the market, and now let's say there's a correction in the stock market and the values of their stock drop. So instead of taking money out of the stock market or your mutual funds, wherever it is, that's when you draw against the reverse mortgage. Give it your money time to recoup,
Yeah.
to recover from.
I see.
So it's a nice, yes, you do.
Yes, I do. I do.
yeah.
So who does that benefit, the reverse mortgage?
Well, it benefits the,
I know they try to sell it to old people.
62 and older.
Yeah.
And let's say you have someone that's they get a mortgage, they're paying like $1,500 a month. Well, replace that mortgage with the reverse mortgage. Now they don't have to make that $1,500 a month payment. That's a lifestyle change for most people.
Yeah.
$1,500 a month.
Sure. Now, but then when that mortgage comes due,
Yep.
you know, or the transfer of the house to the kids
Yep.
or whatever, who gets screwed?
Well, whatever the balance of the
Mortgage is due.
right. So, well, it eats into the kids' inheritance. There's one.
Okay.
So kids have to decide, what's more important, their inheritance or their parents.
Oh boy. I'm screwed.
Boy.
Oh boy. Don't throw that option
You know,
out.
I don't even have a third one, to break the tie.
Yeah.
Because I know one would be on my side, and the other one would go, no, what about the money? I'd need a third to go, come on.
So,
You got one on your side.
Yeah, I got one on my side.
So in theory, you would think the value of your property would continue to go up faster than what the reverse mortgage balance would be.
But does the house still gain equity?
Yeah, if it increases in value.
If it increases in value.
Absolutely. So then it's just a regular mortgage payoff
Right.
at the end.
At the end.
And because all that interest...
But all that interest is on top of that.
Right, and when it's paid off, all that interest can get written off on the taxes. Once that's all paid off.
Oh, well, that's interesting.
Yeah.
Because, I mean,
Yeah.
you hear a lot of negative things about reverse mortgages.
Well, they're
Yeah.
harder to get than you think.
So it's to give you... You're right. So if someone's 62 years old, the most they're going to get is like 30% of the appraised value.
Right.
And if
And if you already have a big mortgage on there, it's not like you can pay off that mortgage.
No, then the numbers wouldn't work. Absolutely, yeah.
Right.
Yeah,
So if you have a $500,000 house, $250,000 mortgage,
you're not going to
work.
No.
Right.
No, unless you have extra money to come up with the difference to pay off.
Oh, yeah.
Yeah. The only thing is you want to be careful even if you didn't have a mortgage, you still have to pay your real estate taxes and homeowners insurance.
yeah.
You know,
Yeah.
so there are cases.
It's not a complete get out of jail card.
No, no.
Right.
But there are cases where their houses were being foreclosed on. They didn't have a mortgage, but the town was going to foreclose because they didn't pay.
Yeah.
You pay taxes.
So
yeah.
what they would do, they would actually still give them a reverse mortgage. But what they would do is calculate, depending on how old they are, they'd set up an escrow account to cover the real estate taxes for maybe 10 or 15 years.
A lot of people get that reverse mortgage just to pay off those taxes,
Yeah,
right?
yeah.
And
Yep.
customary. What do most people do? Do they get that one lump sum or usually?
It's kind of like a combination because some of it will be to pay off the mortgage. And then the idea is to try to, I like the line of credit one because it increases the available.
So in that line of credit, you're not paying for that any interest on that unless you use it.
Correct.
Okay.
Yep.
So you could get a $250,000 line of credit,
Mm-hmm.
and then if you don't use it, you're not getting
Right. And the available credit increases every year.
Yeah.
And as long as your primary residence,
automatically just gets increased
Yep.
every year.
primary residence is defined living there from 181 days.
Yeah.
Yeah.
Yeah. So
Translation.
What do you think about that?
So
I like it.
So that's six months and 1 day.
Right.
Yeah.
To put it another way.
Yeah, maybe you don't like your kids.
You know?
You know what I mean? Maybe you're having trouble with
Yeah.
the family, and you go.
I've had customers that said that.
So you do that one more time. I'm taking out a reverse mortgage.
Reverse mortgage.
I'll show you
yeah.
guys.
Yeah, I'll be dead. I don't care.
No, I had with this one woman. She goes, "Kids, those bastards, screw you. Take care of me first."
Yeah.
So
Some people think that.
If the remaining one dies, how many months do you have before you have to pay the loan off, or the heirs have to pay the loan off? Is it?
I would say within 6 months.
Yeah.
At least show that you're making an effort.
We have one now. Yeah, you just got to talk to the lender.
Yeah.
And keep getting extensions on that because sometimes there's nasty probate going on.
Yeah, I know.
And they don't get resolved very quickly.
Nope.
So you do have to keep asking for extensions. I think if you keep notifying the bank up front. So
Yeah, I mean, because some people, you might have one of the years might want the house, and then so they would probably refinance.
Right. Now, say you have a irrevocable
trust.
family trust. Does
Yeah.
that affect anything?
Yeah, you can't put it in one.
yeah.
You can't get a
Cannot.
reverse mortgage.
No,
How
They-
come?
because then
they-
you can't foreclose on it for any reason.
I see.
It's
Yeah.
just
Yeah,
it
you
has
gotta-
to be revocable.
Well, there goes that.
It can be revocable.
Yeah.
Yeah.
Just can't
Yeah,
be.
yeah.
Wait, and what's the difference between? I guess I know
That's
the
a Rick
difference.
question. Go ahead.
Yeah.
So irrevocable.
means that you can't do anything about it.
Exactly. So in the revocable ones, you can amend
you
it.
can go. I was kidding.
Stop it.
But then
I didn't know you were going to
So the
believe me on that
question
one.
to Rick is, why would someone get an irrevocable versus irrevocable
Right.
For better estate planning for like
protection?
health care and
Okay.
all
Oh,
that.
right.
Yeah.
Okay.
So they
So
see-
which one's better?
Well, and again, we're not. You guys call your own attorneys and accountants.
Or
but-
call Ricardo.
or call
So
them.
this is like
But-
talking about qualifying for maybe a nursing home or Medicare.
Right. So
and all-
those you want to go probably
Irrevocable.
irrevocable.
So, because then they
Right,
can't go after the house because the house is in
right,
there.
in the
right.
trust.
Got it.
Right.
So that protects.
So a lot of these really trust the revocable ones. A lot of times to avoid probate. So it's pretty much automatic.
Right.
Like you can put you as the trustee. If something happens to you,
Then
you
my
could-
wife becomes a
your
trustee,
wife. But
right.
if something happens to both of you, Gus might be the
Guess would
trustee.
be- yeah, next.
Yeah, exactly. You could do it that way. So it's a lot easier for probate purposes. And it's also good to put it in just a simple real estate trust to avoid liability.
Right.
So if there's ever a lawsuit on someone trips and falls, they can only go after the property as opposed to you personally. So that's,
I see.
Those are the two big reasons.
what about creditors?
creditors? They can find you.
Okay.
Yeah.
All right.
Yeah. So it'll depend on how it's set up. Yeah. So, and as you hit on the head, no matter what, taxes can always follow you. So,
Taxes they'll find it.
they'll get you.
They'll
Those
get you.
real estate
Yeah.
taxes there. So,
Yeah.
you guys don't do a lot of reverse mortgages, do you?
We do.
Do you?
Yeah.
Huh. Okay.
You know where it comes into play is the gray divorce. They call it the gray divorce. Seniors 62 and older, the divorce rate has tripled since the 90s.
Really?
Yeah.
Yeah.
You know, it's just, you know.
I can understand.
Well, after a while, you know, because people are living longer, right?
Yeah.
They're looking at each other going, I got another 20 years.
Yes.
I don't know.
kidding me?
I don't know if I can make this.
Yeah.
Give me 20 good years of my life,
Yeah.
right?
Yeah.
And then,
Well,
so then the other spouse will say, all right, fine, but I want to keep the house, but I can't afford the mortgage. Then
then you get a reverse.
get a reverse.
And everyone gets a little bit.
Yeah.
How do you handle the divorce? What do you see with the divorce? You do a lot of divorce
Yeah.
mortgages. Well, not divorce mortgages, but people
Helping people navigate.
Exactly. What do you see now? Give us some tips on that.
So, well, for
Before-
openers, I like to work with folks that are in either mediation or collaboration because they're more likely to want to work something out. You know, because if you got someone
Those are
that's
such
If it's
nice,
acrimonious.
those are such
Right.
nice terms.
Yeah.
But once you get into collaboration, people are going crazy.
They're not
with these-
collaborating.
no, they're still collaborating. It's
Yeah.
it's when you start getting into the litigation, they're throwing rocks at each other.
Yeah, yeah,
I'm not
yeah.
talking to them.
Yeah.
Right.
Yeah.
You know,
But
but when
even-
it's
even-
acrimonious.
Yes,
But even
exactly.
even in mediation, everything sounds great, and then when it starts that last 1% of the transaction,
Yeah.
Right. When you actually have to put it into
Right.
action, they go, now with you. Yeah.
you know,
I've done some closings where they to the very end they torture each other over about the littlest things.
Yeah.
Like the oil adjustment. You're not getting half of that. I'm
Right.
going to pay. Yeah, it's just. I think it's that last ditch effort they can torture their spouse as they go out the door.
Yeah.
Yeah.
you know,
just
because I've had cases where one spouse would say, the other spouse's sole mission is to torture me
Right.
at all costs.
Yeah.
Good Tony shaking his head. With
Right
her,
down to the penny. Right.
with her. So, what's your strategy for? What if some? Here's a problem.
Yeah.
People getting divorced. They have a rate of 3%.
Yeah.
One wants to buy the other out. Now they got to refinance to buy the other one out.
Yep.
Now the rate's at 7%.
Sure.
I mean, you're going to lose a lot of.
So
yeah.
So in a situation like that, you got to first say, okay, what's the end game here? Like, what would be your ideal?
What are you
outcome?
hoping to get out of it?
Yeah,
Right.
yeah. And some might just say, I just want to pay my spouse off. We'll do an equity buyout, and I just want to own the house outright at all costs. But it's 7%. I'm going to give my spouse $100,000. Geez, my mortgage payment's jumping up to $700 a month.
More. Yeah.
Yeah, but I can't afford that. And then I would say, okay, so instead of taking out $100,000, why don't you? Maybe you want to keep the house for another 4 years, and it's going to cost you an extra $30,000. Maybe we'll just take out $130,000. Your spouse will get $100,000. You take that $30,000 and put it in a separate account to help offset that extra payment. Okay. So it's a way of getting them to keep it.
That $30,000 is paying the fees over the years.
Yeah, right. Because in that situation, this isn't like your simple financial planning situation. It's more like I got to get out of this situation, and I need to. It's a transitional approach, strategy to get you through the next 4 years. Because you might have, the kids are in high school, and you want them to, not leave the community or the house or anything like that. So they graduate, and then after that, they'll sell the house then.
Most of this comes down to how ethical and nice person you are.
That's right.
Yeah.
That's right.
And
That's right.
Or how much you want to screw somebody over.
Right.
And some people live for that. I don't like that.
I've seen closings where I go, man, just let it go,
Well, right. And I always say, there's life after divorce. The question is, what do you want your life to be like?
Yeah.
Right.
Yeah.
Period.
All right. We got 1 minute left. People always ask me after you leave, give us like 3 or 4 quick tips. I know this isn't your complete bag, but how to improve their credit. And then we're going to wrap up for today.
Okay. Well, it depends on what their credit's like. So, number one, if you're maxed out on your credit cards, that's going to drop down your score. So if you have any way of trying to pay down the credit cards, just work on paying it down to available
Like
credit.
50% of
even lower than that.
Okay.
Probably like 25.
Okay.
That'll get your score up.
Yeah.
If you're behind in your credit, do what you can to try to start making the payments on time, because after like 12, 24 months, they'll get your score back up. Because it's this credit score, the FICO score.
Yes. Is there a way to find your FICO score yourself?
How would you do that?
I would just go to goficoyourself.com.
That, you know what? That's been getting a lot of hits lately. Yes. How often can you FICO yourself, do you think? And is there a certain time of day?
Well,
all times. There's always the right time to FICO yourself.
It varies per individual. So
Yeah. If you want to rebuild credit, you can get credit cards. There's a nice website. It's called creditcards.com.
Oh.
I
And
like yours better.
It all goes hand in hand.
Yeah, so to speak.
Yes. Yes. And so you can get a credit card no matter your situation. If you just came out of bankruptcy, foreclosure.
So speaking of that, and we'll wrap up with this one. If you're maxed out at one credit card, should you get that second credit card?
Why not?
Okay.
Yeah.
You obviously don't care. Why not get 8?
Yeah.
Only have 1,000 on each of them.
Yeah, that's all. Spread it out.
Instead of 8,000 on one.
Well, I will tell you what you don't want to do.
Okay.
Let's say someone's pays off their credit card, and for some reason they're just so angry at it for some reason.
Yeah.
Don't close it out because you probably had that for about 5-10 years. That's
It's
nice
good to have a
established.
card, right.
Yeah, because if you close that out, your credit score will actually drop.
Really?
Yeah.
Yep.
Yeah.
Why?
Because you just got rid of your credit score was based on longevity of that credit
Oh, I see.
history, and you just got rid of it.
Yeah.
Right.
Yeah.
And I tell people just leave it.
Just
leave
keep all
it-
your
leave
credit
it be.
cards.
Yeah.
Right.
Yeah. The only thing you want to be careful of, if that credit card happens to have an annual fee and you don't get do paperless statements,
Yeah.
Yeah.
and you're not doing it, all of a sudden when the fees due, you're going to get hit. But if you're not paying attention,
You don't
and
pay it for years
don't pay it,
later.
right.
Yeah.
That can hurt your credit, so it kind of defeats
You know
itself.
what even is better? Get other people's credit cards.
yeah,
Or get yours and have them co-sign.
Yeah, sure. Run them up.
other
Sure.
people's money.
Yeah, of course.
Yeah, OPM.
Oh, you mean people you don't even
Yeah,
know?
you
Just
don't
grab
know.
their
Just
credit
grab-
cards.
just
Right.
grab- They leave them around.
See, this is why you got to listen to the show till the very end, because you get some real good pointers at this point. If you're running into a little bit of trouble, just grab someone else's credit cards.
That's all you got to do.
All right.
Go to the Bahamas.
Yeah.
See you in Aruba.
You could do that.
Yeah, all right.
There's a lot of that going on.
Well, with that being
That's
said,
Nothing else need be said.
With that gem of a tip there, we're going to head out and see you next week here on the Real Estate House Party. Thanks for joining us. John Marroni, the 8th man, Tony V. We'll see you.
Peace.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Café, the United Podcast Network, its partners, or affiliates.